Good evening. It is really an honor to come to this admirable university to deliver the Walter E. H. lecture. I express my gratitude to the Committee on Public Lectures of Princeton University for the opportunity to address this very distinguished audience. And of course, I want to thank my countryman, Professor Gallo, for his generous introduction. I think you have really overstated my case. Well, first I have a clarification and perhaps an apology to make. At the time that I received the kind invitation that brings me before you today, and thinking at the time that rather soon many Latin American nations will be commemorating having reached 200 years since the start of their independence revolutions, I had decided to use this opportunity to only glance, at some of our achievements and failures in our region that had occurred in these almost 200 years of independent life. Well, that thought, which is reflected in the title, Latin America, 200 Years of Solitude, was in July of 2008, which is when I received the invitation to come before you. Well, since then, the world has been stricken by the first great crisis of the 21st century, a circumstance that will pose a very serious, I would say, a dramatic challenge for the Latin American countries. So I have been compelled to abandon my attempt to become an economic historian and go back to my field of expertise, and therefore I want to use this occasion to reflect on the immediate future of the region, but certainly through the pertinent lens of our past experiences. I want to start by noticing that in the brief period since this century began, globalization has presented Latin America with greater opportunities and greater risks than it has faced in a long time. Until very recently, opportunity came in the form of exceptional expansion of the global economy. Today, risk presents itself in the form of a financial crisis that began in the United States in mid-2007 as the subprime problem, evolved into a systemic disaster by last fall, and will very likely become, in 2009 and beyond, the worst global economic recession in 7 decades. With the end of 2008, Latin America concluded 6 years characterized by an average economic growth rate higher than that of any comparable period in the last 4 decades. True, this performance was assisted by significantly improved domestic economic fundamentals in most of our countries, yet it would have been impossible to achieve without the extremely favorable external conditions that arose in 2002 and continued well into 2008. During those years, most of our countries benefited from a growing international economy, quite favorable terms of trade, and global capital markets with very high liquidity and very low interest rates. One would be hard-pressed to find another period in recent history where so many external factors align almost simultaneously in a manner favorable to the Latin American economies. We can say that globalization was working for us until very recently. The fact that the economic bonanza endured for more than a year after the summer of 2007, when the crisis here started, made some people believe that our economic evolution had effectively decoupled from that of the countries immediately affected by the financial crisis. It is quite suggested that even after the collapse of Lehman Brothers, the Brazilian president remarked, and I am quoting, "People ask me about the crisis, and I reply, go and ask Bush, it's his crisis, not mine." This was around September 20 of 2008. Well, today, there is no longer any doubt. The American affliction has become a global pandemic, and the countries of Latin America have entered a difficult period that could shape our economic and even political evolution for probably a long time. Recent events should make political leaders in Latin America acknowledge two facts, one good, one bad. The good one, the reforms undertaken in our countries during the late 80s and 90s have undoubtedly proven worthwhile. Lacking the solid base those reforms provided, the financial crisis would have completely devastated our economies by now. We were able to evade disaster during the second half of 2007 and a good part of 2008 because our countries have healthier public finances, more solid banking systems, more flexible exchange rate policies, considerable amounts of foreign exchange reserves, greater openness to trade and investment, and more independent central banks focused on fighting inflation. The bad news is that Latin American political leaders will soon regret not having gone deeper in the reform processes. It appears that the years of continuous economic growth brought about by globalization greatly undermine any sense of urgency to continue such processes. With the possible, and I would say very likely, exception of Chile, governments will soon realize that they have few instruments at their disposal with which to ameliorate the social and economic effects of the global crisis. They will find out that their economies were strong enough to resist the first disturbances of the financial storm, but that they lack the necessary strength to deploy counter-cyclical policies to preserve intact what was gained during the recent expansion. I truly hope that our governments will accept reality and not fall into the illusion that it is possible to compensate significantly for reductions in the demand for and prices of our exports, the collapse of international credit and investments, significant decreases in remittances from our workers abroad, and many other adverse factors which are really beyond our control. In confronting this crisis, the Latin American leaders must be very conscious of history and avoid making the kinds of mistakes that led to dire consequences in the past. In particular, they must revisit the ways in which governments dealt with the shocks to the global economy in the 70s and the 80s, and realize the dreadful effects they had on our countries. Practically, every Latin American government reacted to the oil shocks of 73 and 79 with massive increases in public spending, price controls, gigantic subsidies to inefficient industries, the creation of numerous state-owned enterprises, incongruent exchange rate policies, and a retrenchment from international commerce and investment. Far from encouraging prudent austerity, the international recession unleashed a populist wave throughout the region. The populist excesses incurred by both civilian and military governments, at the time very popular in Latin America, caused the fiscal and current account deficits to grow out of control throughout the region. Ample financing stemming from recycling petrodollars, which was provided this financing by imprudent international banks, created the delusion that the orgy of overspending could last forever. But of course, the day of reckoning had to come sooner or later. In 1981, the Federal Reserve of the United States, then under the leadership of Paul Volcker, by the way, a Princeton man, finally acted to reestablish price stability in the United States by restricting the growth of the monetary supply and letting interest rates to rise to very high levels. Latin American governments and businesses were caught by the Volcker shock treatment with foreign debts many-fold bigger than the ones they had a few years earlier. Even though servicing such debt became more expensive, our governments continued without adjusting aggregate demand, soliciting and getting even more foreign credits. For a while, banks kept lending to us, albeit with shorter and shorter maturities and higher spreads, but eventually they stopped and began demanding repayment on short-term loans. At the end of August 1982, Mexico announced that it was unable to service its external debt, a road quickly followed by other Latin American countries. This series of events marked the beginning of what would come to be known as the lost decade for Latin America. Meanwhile, the so-called Asian tigers that had adjusted themselves unhesitatingly to the external shocks were quickly able to get back on a path of vigorous economic growth. In Latin America, the main lesson to be drawn from the 70s for dealing with the present crisis should be quite clear. It is very risky to try to borrow your way out of an international recession. Although public finances and balance of payments are in better shape than in the past, this improvement will not allow us to compensate for the decline in external demand with fiscal expansion. Raising public spending considerably or decreasing tax rates will set in motion a trend of severe deterioration in the current account of our balance of payments that simply will not prove financeable under the present circumstances in international financial markets. It is not only that the global financial system is enduring a dramatic contraction, it is also that we will be, and are already, brutally crowded out of those markets as richer countries deploy counter-cyclical policies that will lead to fiscal deficits, which in cases like that of the United States will be the biggest since the end of the Second World War. Whatever credit might be available in international markets will probably go knocking first on doors others than ours. Even in the unlikely scenario of a quick foreign credit revival, it would be unwise to mortgage the future recovery of our economies once again. Prudence dictates allowing nations that emit reserve currencies, as well as those that have generated excess savings in recent years, to shoulder the initial burden of fighting the world recession. The best course for our economies, and I think also in favor of the global economy, is for us, Latin America, to adjust in an orderly fashion to the decline in world demand and the reduced availability of international finance and investment. We should avoid compounding the global disaster with a balance of payment crisis in any of the major Latin American countries. One cannot deny that this crisis is highly unfortunate for our countries, especially since the macroeconomic adjustments that we will have to endure, whether we like it or not, ex ante or ex post, will take effect without having made sufficient progress in improving the social and economic conditions of our populations. Consider that in 1990, almost 48% of families in Latin America live in poverty. Since then, we have only been able to decrease that proportion to 40%. Moreover, as is well known, our region continues to have among the highest levels of economic inequality, having made very little progress in the last 20 years. In these difficult times, we must do what regrettably overlooked during the 70s and early 80s. Instead of embarking on populist adventures, which move us farther away from achieving economic convergence with the advanced nations, we should seriously reflect on our structural weaknesses and take advantage of the feeling of urgency that is sure to emerge from this great crisis in order to act with a long-term vision, retake the process of reform, and position ourselves well for the global economic recovery that eventually will arrive. To begin such a reflection, it will be convenient first to pose the right question. What is the immediate impediment to Latin America making satisfactory progress in its key social indicators? Persistent, insufficient economic growth is the immediate cause of our failure in resolving our acute social problems. It is a well-documented fact that the economies of Latin America historically have grown at a slower pace, not only than their more developed counterparts, but also than other developing nations in recent decades. If our aim is to seriously attack the deficiencies that prevent us from solving our social problems, we must first understand why we continue to grow at a slower pace than the rest of the world. The answer to this question is neither obvious or simple. Numerous prior attempts have resulted in a multiplicity of complex and even contradictory answers. Although I do not intend to offer a detailed recapitulation of such attempts, it is worthwhile to point to some observations from recent studies, as well as the report by the Commission on Growth and Development, which was chaired by Nobel laureate in economics Michael Spence, that had Bob Solow, another Nobel laureate, as its member, and of which, for reasons that I ignore, I was also a member. In that commission, we look at the cumulative experience of growth and development of the dozen or so economies that since 1950 have grown at an annual average rate of 7% or more for 25 years or longer. At that pace, an economy doubles in size every decade. By comparing successful and unsuccessful cases, we try to pinpoint the conditions that likely aided in the ability to reach and sustain high levels of economic growth. And I find this exercise of particular relevance to Latin America. In this study and in other studies, to no one's surprise, it has been found that the proverbial macroeconomic instability in Latin America, expressed as volatility of the national product per capita, high inflation rates, and recurrent crises in finances and balance of payments, has been a major inhibition to economic growth. Economists of various schools of thought, from neoclassical orthodox to modern revisionists of the orthodoxy, have reached the same conclusion. Overlooking the importance of the essential macroeconomic equilibriums, as we did frequently in the past, sometimes by the way invoking social justice as the primary motivator, has led to gigantic costs in lost product and employment, as well as the worsening of poverty levels. It is fortunate, I must say, that a commitment to maintaining at least elementary fiscal and monetary discipline seems to have become a point of agreement in most Latin American countries. But macroeconomic discipline is a necessary but not a sufficient condition for a good economic performance. Without such discipline, one is sure to confront crisis and lack of economic growth, but by itself does not guarantee higher levels of economic growth. More pieces are needed to solve the puzzle of the poor Latin America economic growth record. Some clues can be found in the growth accounting statistical studies, whereby GDP growth is essentially explained as a function of growth in the physical and human capital and the degree of technological progress. The expected result for a developing country is that thanks to the abundance of labor, the speed of growth is limited essentially by the rhythm of investment. Likewise, just as growth depends on investment, investment depends on savings. Well, on average, the savings rate in a region is less than half of the rates registered in the emerging economies of Asia. In the 1970s, both Southeast Asia and Latin America had similar savings rates. 20 years on, the rate in Asia was about 20 percentage points higher than ours. China has been saving more than 30% of its annual national income for the last 30 years, and actually close to 50% of its GDP in recent years. If we take cases of success as our guide, it appears that total investment rates above 25% of product are indispensable. Furthermore, it is worth noting that in the Asian economies of high growth, public investment in infrastructure has represented between 5 and 7% of their GDPs. Additionally, those economies invested between 7 and 8% of their GDP in education, job training, and health services, which does not count as investment in the national accounts. Of course, in principle, countries could rely on foreign savings to finance their investments. However, external savings are an imperfect substitute for internal savings. Excessive reliance on external savings is quite risky, as was proven many times in Latin America and more recently in the largest economy of the world, the United States. In the Growth Commission, we found that all trajectories of high investment and GDP growth were sustained essentially by internal savings. All stories of success have been stories of looking beyond the horizon, sacrificing present consumption in hopes of better incomes in the future. Although there is no question that the primary motor of economic growth is private investment, it is also true that no country has been able to maintain high levels of growth without high levels of public spending, public investment on infrastructure, health, and education. Such spending, far from displacing private investment, facilitates as long as it is financed soundly. Yet, there is no mechanism that directly transforms investments in human capital into growth. There are other factors at play. And I must say that in most of our Latin American countries, education spending, which is the most important item of investment in human capital, is affected by serious deficiencies, constituting not only a limitation on economic growth, but perhaps more importantly, a cause of severe inequality. Political interest groups have captured our educational systems, raising barriers that diminish markedly the effect of policy interventions aimed at improving the quality of education. Well, but nevertheless, it is interesting to note that some of these statistical studies conclude that in general, the low levels of growth in Latin America originate not as much in the insufficient growth of our physical and human capital, but rather in the low productivity with which we apply these productive factors. This means that in order to increase GDP growth, it would not be necessary for us to wait to raise savings and investment rates, nor we will need to wait for the removal of all the obstacles that limit our formation of human capital. Instead, we could tackle the impediments that currently prevent increasing the so-called total factor productivity. This does not in any way imply, of course, that economic growth in our countries would not be improved significantly by higher savings and investment rates, as well as by better human capital. The point is that if we believe, and there are good reasons to believe, that it will be hard in the short and medium terms to augment the savings and investment rates and the accumulation of human capital, then we better pay more attention to the causes of low productivity of the already available productive factors. Our economies are less inclined toward innovation and therefore less productive than others because of the obstacles that exist in nearly all of our countries to the development of new markets, businesses, and products. In this Growth Commission, we observed that all economies that have maintained high growth have relied on the market system to distribute scarce resources. They have, as other market economies, undergone an admittedly turbulent process which leads to the creation of new activities and sectors while other more traditional activities and sectors are abandoned. Structural change taken under pressure from competition is what ignites, raises, increases in productivity. Consequently, governments with a true commitment to reaching high levels of growth must liberalize their product markets. That is to say, governments must facilitate as much as possible the creation of more businesses and their entry into competition, as well as facilitating the dissolution of those enterprises that are unable to compete. They must at the same time promote the flexibility of labor markets so that new businesses quickly create new jobs and workers can quickly occupy them. Labor mobility has been a constant factor in all cases of high economic growth. In poor and highly populated countries, jobs, we all know, are hard to acquire, wages are low, and a large part of the population is self-employed, not by choice, but by necessity. This unfortunate situation is where a 7% level of sustained economic growth for 2 decades is aimed at solving. For this to happen, labor must be mobile. It must be able to switch from working on the land to working in a factory, from one industry to another, from the informal economy to the formal economy. And there's, of course, a lot of that governments can do to augment labor mobility. They can train their workers, they can educate their workers, and more importantly, they should create reasonable social safety nets. Yet, at the same time, states should reform their laws and institutions to make it possible for the poor to get employed in the formal sector instead of continuing to be underemployed and underpaid in the informal sector. Unfortunately, despite the economic liberalization of the last 20 years, competition, which we must insist has always been the primary motor for innovation in successful economies, remains very limited in Latin America. It is quite telling that the 2009 edition of the World Bank's Good Study, Doing Business, which contains data for 181 nations, finds Brazil, Mexico, and Argentina at numbers 127, 115, and 135, respectively, in terms of ease of opening a business. On the index that measures convenience of employing workers, these same countries occupy spots 121, 141, and 130. These and other factors explain why the Global Competitiveness Index, which is elaborated every year by the WEF, informs us that among the 135 nations in its most recent publication, Brazil occupies 64th place, Mexico 60th, and Argentina 88th. Not only have our economies have been more reluctant to accept international competition than, for example, the American, the European, or the Asian economies, but we have also maintained much larger barriers to internal competition through a variety of instruments. For many years, we were the unfortunate champions of trade barriers, and when finally we decided to open our economies, we managed to continue to inhibit competition within our borders. For this purpose, we keep using a whole gamut of tools, from onerous barriers to entry in the formal sectors of our economy to the persistence of labor laws that penalize the employment and training of the labor force. Impediments in the registration and legal protection of property rights, as Hernando de Soto has studied very well, are another powerful force that conspires against competition and strengthening internal markets. Ironically, it is the poorest whose protection is usually championed by the skeptics of the market economy, who suffer most the consequences of the lack of economic freedom and competition that still hinders our economies. And it is not ironic, but rather a consequence of self-interest, that frequently those who have received the biggest benefits from our incipient capitalism are among those who most strongly oppose any increase in internal or external competition. These are the same people who insist that an unrelenting trade-off between markets and the state is inescapable. In reality, this is a false dilemma. Historically, the role of the state is crucial to the creation of market economies that are more efficient, dynamic, and inclusive. Even though the private sector must be the largest generator of investment and employment, the role of the state is equally essential to obtain sustained growth. Fundamentally, without government, there can be no market economy, for an effective market economy necessitates the rule of law that can only be provided by the state. Justice and the use of force to ensure it prevails constitute the only monopolies that cannot be relinquished by the state. A fair and efficient legal system is indispensable not only to provide the security and the protection of the political and human rights of individuals, but also to guarantee their property rights and their freedom of initiative, without which it is impossible to develop a vibrant market economy. Latin American states also have often failed to recognize that for growth to be sustained, it is essential that its benefits be distributed in a more equitable manner. They have failed to distinguish equity from equality of opportunity, confusing the instruments that must be applied for each of the two objectives, and as a consequence, decreasing incentives towards savings and work. Indeed, equality of opportunity is served by providing universal access to public services like health and education, but is also served by building what might be called the infrastructure of popular capitalism, providing, again, quoting Hernando de Soto, providing poor people with legal identity, securing rights to their property, and access to saving and financing instruments. These tools for the empowerment of the poor have been neglected or at best pursued only timidly in most Latin American countries. The governments of countries that have succeeded in achieving fast growth have been keen to try, not afraid to err and willing to learn. Well, it seems that in Latin America we have tried, certainly erred, but seldom learned from our own mistakes. And this is a big problem. The cause of this misfortune is not in the economy. It seems rather to be in our politics. Some analysts believe that our problem now is our inability to settle on what can and should be done. They remark that the political polarization, which is a reality in most of our countries, makes it impossible to reach the necessary consensus that would allow to carry out the pending and necessary reforms. Others insist, actually, that our problem lies in our democracy. And they remind us, with their gaze on the Asian experience, that developing nations that have been successful have implemented the correct policies under governments that are not exactly what we will call democratic. Well, those skeptics of our incipient democracies would do well to recall that during almost 2 centuries of independent life, we Latin Americans have proven ad nauseam that on our side of the world Authoritarian regimes and good policies never come as a package. Our rich history, and on this, our history is very rich, through almost 200 years, suggests exactly the opposite. We don't even have to look back in history to point out that even today in Latin America, the most absurd management of the economy exists where there is no democracy or where it is threatened with extinction. The problem is not how to reduce, but rather how to strengthen our democracies so that they produce better results. We require agreements on specific reforms, agreements that our countries do not seem yet capable of reaching. Actually, our problem is not that our politicians or parties or our societies are not adept at reaching agreements. The main problem lies in the weaknesses of our institutions. This weakness makes it harder to reach the fundamental agreements, magnifies the risk and cost of policy mistakes, and when we finally reach a consensus about a necessary policy, that leaves us with very little margin within which to implement them correctly. We encounter a vicious cycle with institutional weakness leading to bad public policies. The bad policies produce bad results undermine democracy, and when this happens, our institutions weakens still further. Breaking this vicious cycle is our primary challenge. Is the solution a continual discussion of the policies until we reach an agreement? I think not. Please do not misunderstand me. Disagreeing, debating, and conceding are always necessary in a democracy. But the value of reaching agreement on economic and social policies is limited by the institutional capacity to execute these policies efficiently and steadfastly. And I do not tire of insisting with my fellow Latin Americans that without restricting the necessary debate and political negotiation, let us in the end allow democracy to decide who deserves the opportunity to show that their proposals are the correct ones, but that we must work together to make sure that our institutions are sufficiently solid, firstly so that the democratically elected government has the necessary tools and opportunity to implement its platform, and secondly, to prevent a catastrophe if such platforms turns out to be wrong. The vicious cycle must be broken by correcting our institutional weakness, I insist. I suppose that some of you, even if you are in agreement with my suggestion, will believe that this will not take us far enough. Some will ask, if we cannot agree on the economic and social policies that we must change, how will we be able to agree on the institutions that we must reform? It is true that we will not be able to agree on all the necessary institutional reforms that we need, but there is one on which we can all agree in Latin America, and that may be also decisive in breaking the vicious cycle clogging our development potential. I am speaking of the rule of law. We need not substantiate that claim that in general, the rule of law is palpably deficient in practically all of the Latin American countries. Notwithstanding some very valuable reforms in recent years, it is well known that our systems of justice and security are far from able to guarantee all people effective equality before the law. They cannot protect efficiently the rights of people, including the right to personal security and patrimony. They also frequently fail to make citizens comply with their obligations to both institutions and society. Even in countries with the largest economies in the region, the state cannot fulfill satisfactorily the administration of justice. Enforcement of the rule of law is important for many ethical, political, and social reasons. It is also crucial, let me insist, in order to promote and obtain development. No country has achieved prosperity, I insist, without a market economy. Further yet, no country will remain prosperous without a market economy efficiently inserted into the global economy. And no underdeveloped country has stopped being underdeveloped and overcome poverty without a market economy that is dynamic and inclusive. Yet, the complex networks of exchange for goods and services that make productive specialization, formation of new businesses and enterprises, the creation of new productive jobs, the local, national, and international commerce and financial transactions possible, and which in conjunction constitute a market economy, I stress it again, cannot develop to full fruition without a solid legal system. That is to say, a legal system with clear and fair rules and mechanisms that allow for swift and just application. As I mentioned before, it is the poorest among the population who suffer the most from a lack of economic freedom and exclusion from the opportunities that a market economy provides. This happens not only because of limited access to certain goods such as education, health, and basic infrastructure, which leaves them, to begin with, at a disadvantage, but also because they also suffer discrimination in the exercise of their property rights and freedom of initiative. Strengthening our states so that they can effectively deliver the administration of justice should be a point of a strong political convergence, despite the ample ideological diversity that fortunately exists in Latin America. We can continue to disagree on other necessary reforms and let decide democracy among our differences. But it is urgent, and importantly, it is possible that we finally unite in each of our countries with clear determination to construct the necessary rule of law that until now has eluded us. To set off in this direction, we do not need to wait for our countries to overcome the ongoing economic disaster. It is a task that can be undertaken at the same time that we make the necessary adjustments to confront the international recession. In this lapse, the democracies we have constructed in the last 20 years will be particularly valuable. I am quite confident that there will be an orderly adjustment and even a revival of the structural reforms in the Latin American nations where the indispensable democratic check and balances exist. This is fortunately the case in the majority of our countries and certainly in the largest economies in our region. I am afraid, however, that the risk is much higher, unfortunately, where democracy has been weakened by the abuse of power in complicity with citizens' wrong-headed devotion to populism. It is precisely in those countries that it is more likely that the lessons from the past will be forgotten, the wrong policies adopted, and that the people will end up paying a huge price for the first global crisis of the 21st century. Thank you. And I will be very happy to move to the good part of the session, which is your questions. And we have one microphone there, please.
Okay. Thank you for the very interesting talk. And you have accomplished a lot as the president of Mexico before, and if you were the president of Mexico again, what are the 3 top things that you would like to do to address the challenges in Mexico and Latin America?
Over dinner, somebody asked me what would make me go back to politics, and I said what would make me an active politician again, and probably a violent revolutionary, would be any attempt in Mexico to reestablish re-election. So your question has no answer. Another question?
If I'm not mistaken, in a recent, well, with President Gaviria and Cardoso, you mentioned that the war on drugs has been a failure, and that new policies need to be considered. And I am very interested in the topic, and I wondered whether you could expose some of your viewpoints on the issue and of why the war on drugs has failed.
Well, it has been not only in the context of this Drugs and Democracy Commission, of which I was part with President Cardoso and President Gaviria, but also as part of other endeavors. More recently, a commission on U.S. Latin American relations, a commission established by Brookings Institution, which I co-chair along with Ambassador Tom Pickering, where I have been insisting on these points. I mean, and every objective indicator of consumption, price of drugs in the street, people in jail, violence, point very clearly that the approach that has been followed in recent decades to fight drug trafficking has failed. There is no way, nobody can claim with objective indicators that the strategy is succeeding. And therefore, in that Brookings report, and also in this Drugs and Democracy Commission, we have called for, number one, an open debate of the question. Because quite frequently, this is a topic that, unlike other topics, important topics, cannot be discussed with the freedom, with the intellectual freedom that it should be discussed. And this is not right. Second, and more specifically, people like myself have suggested that we should move away from the strictly criminal, punitive, penal approach to fight drugs and start thinking about drug consumption, which I think is a serious health and social problem. Start thinking about it as a public health problem. And I have sustained that the only way in which we can stop the most vicious consequences of drug trafficking is by undermining the black market in which this trafficking operates. And I have said that we have to have policies that move people that unfortunately are addicts from the black market to the health system, so that the economic incentives disappear, and the money that now flows into criminal activities also diminishes. And that has been our point in both studies. And we have decided to speak out in my case because it is very painful to see what is happening in Mexico, what has happened before in other Latin American countries, what is happening in this country. And we want to open this debate, and we want to hear the arguments of other people. This, in no way, is to say that, for example, in the case of my government, should stop what they are doing. I think that given the parameters that the Mexican government is facing, I think the strategy to go aggressively against this criminal activity is the right policy. But I'm also claiming that we should not leave the Mexican government facing all the time the same parameters, that others have an enormous responsibility to change those parameters, because otherwise this is a hopeless situation. That under this strategy, the best that we can wait in Mexico, or we can expect in Mexico, is to push back the problem to Colombia or to Central America or to the Caribbean. But the human suffering will still be there. And I think it's still also a problem of justice. And I tell my American friends, listen, you are putting the money, you are putting the weapons, because more than 90% of the weapons captured in Mexico are weapons legally sold in this country, weapons used by the criminal gangs. And we Mexicans are putting the death and the undermining of our institutions. And this is not a fair deal. So therefore, I reject that we should not be allowed to think and debate this topic.
Is it okay to ask you a question about the diplomacy and the history? Is it okay? We are just slightly going off the tangent. Historian Lars Schultz wrote a book about the U.S. diplomatic policy towards Latin America for the last 200 years. And I think it can be summed up in one word: it's a racist policy. And as it's reflected in its title, called Beneath the United States. Now, my question is, do you agree with that assessment? And then, was that your experience when you were president? And the third, that we have a new president who, at least personally, cannot accuse him of being a racist. What do you look forward to, how he would change?
Well, no, I don't agree that the relationship between the U.S. and Latin America can be defined in that dimension. I think our relationship has been historically very complex. It has had ups and downs, very difficult episodes, but also very positive episodes. I don't think we can say that the U.S. policy towards Latin America has been motivated by any racist or consideration. I think it's much more complex than that. But I think that rather than recriminating or regretting what we have done or we haven't done in the past, I think we should think, precisely now that there is a new government in the White House, that there are a lot of common interests and opportunities. Sometimes we don't tell our American friends how important Latin America is for the U.S. I mean, more than 30% of U.S. exports go to Latin America. More than 1/3 of the oil that is imported by this country comes from Latin America. More than half of the foreign-born population in the United States come from Latin America. And this is an avenue of two directions. And I think there are enormous opportunities that must be tapped. But our American friends have to understand that they have to be more engaged on the positive, addressing certainly the problems, but also looking more closely at the opportunities. Perhaps because we are not such a headache for the United States, frequently we are ignored by U.S. Diplomacy. And of course, we don't want to become a headache, to have a better and more constructive engagement, and I hope that with the Obama administration that happens. What do you have here? And then she.
Thank you. Mr. Zedillo, today in the New York Times editorial, they mentioned that probably the necessity to bail out the poor countries from the rich countries. It's how it sounds to you, in order to avoid a recession. I mean, a bigger recession.
Well, I didn't read that editorial, but, well, it's not about bailing out, but we have a very serious problem. As I mentioned in my comments, the global financial system is contracting. I mean, if you look at the figures of the IFI, the International Financial Institute, there has been, in the last 18 months, a collapse of capital flows towards developing countries. And the situation is not going to get better by itself, but it's going to get even worse. The United States, and this is necessary, will not start anytime soon to correct its huge fiscal deficit, and its current account deficit will not shrink, but probably grow larger. And that means that the United States, precisely at this moment, and this will be a measure of the success of the program, will become an even more important debtor in the international system. So you have a situation in which the financial system is shrinking, but the debtor is demanding more resources. So we, the small guys, are going to be crowded out from international capital markets. And this, I think, can be very negative, because this is going to increase the multiplier of the global recession. It's going to make the situation much worse. It's going to make the temptation of protectionism more appealing, and everybody is going to suffer. So what some people like myself are saying is that the international financial institutions, like the IMF and the World Bank and the regional banks, should be empowered to be more supportive of the developing countries, not so that they go into crazy spending sprees, as we did it in the 70s, recycling the petrodollars. But I think we will need to have the financial backing to avoid situations of panic in our financial systems and aggravate the recessions that we are going to go through. The resources available for at the IMF, 250 billion, are very small. And we have known that for several months, and nothing has happened. So I'm hoping that in this G20 meeting in April, the developed countries and the G20 countries will take the right decisions to provide more resources, because otherwise the recession will be much worse. Here.
Okay, so this might be a slightly more personal question, but considering all that you achieved during your term as president, in terms of government transparency and electoral transparency, how did you feel when Vicente Fox won the 2000 election?
Well, that I was going into the opposition, we lost the first feeling, right? And that is not very nice. First feeling. No, I mean, that's a moment of, there are moments to be partisan and there are moments to be a statesman. And that day, and I was not expecting that, because the election was close, and in fact the polls were not clear that that was going to happen, well, I have to do what I was supposed to do. And you don't think in that moment, oh, I am happy or unhappy. You say, well, what is my duty as head of a state of this country who is committed to democracy? And once you think that, it's very easy to decide what to do. No big deal. He, and then you, green shirt over there.
What lessons would you say that the American financial regulatory system leaves, and like this crisis leaves to financial institutions in Latin America, to like people who are trying to make their countries more just to liberalize financial systems? And I don't know if it's too early for that, but
well, unfortunately, it's the other way around. Our American friends should have looked at Latin American history more closely, and perhaps they should have been able to take some preventive medicine in recent years, because we Latin Americans have gone too often through these cycles of boom and bust, which in many cases typically have had this incredible influx of capital or injections of liquidity that feed people euphoria, and one day we wake up and move from euphoria to depression, and everything collapses. That was the case in Chile in 82, also of Mexico in 82, in Mexico in 94, and actually the Mexican crisis of 94 and 95 had a lot in common up to a point with the crisis that we have seen here. And that was something that I sensed very clearly, because we were on the eve of seeing our financial system to go bankrupt, totally bankrupt. People were about to run against the banks, and banks will have to be, closed or collapse. And that sounds easy to say, but that's a tragedy, because if you allow your financial system to collapse, then you are allowing your payments system to collapse. And if your payment system collapses, then your real economy, productive economy, also collapses. And you can have, in a matter of days or weeks, incredible human tragedies in terms of unemployment and lost incomes. And that is a decision that you have to face when you sense that that is happening. I sensed it in 95, early 95. And I suspect that on the night of September 17 of 2008, Chairman Bernanke and Paul Paulson realized that that was about to happen here. And that's when they went to see President Bush and said, you know what, we are going to go to Congress to ask for money to start saving the banks. And that's very tough, because, believe me, saving banks is not popular anywhere in the world. It hasn't ever been popular. And people get mad, and feel bad about it. But if you don't do it, then the price that you have to pay, the human price, the social cost, is much higher. And then I have to be more panoramic.
Can I bring you back to the issue of re-election? And I can't help but think of Venezuela and what's your opinion of re-election as a political institution in Latin America? Does it strengthen or weaken the Latin democracies?
Oh, no, I think history is obvious. I mean, the darkest side of Latin American history has to do with people that have tried to perpetuate themselves in power. So that's my answer. And I think historically we paid a very high price, and those that keep in doing that will pay a very high price.
Prior to the economic crisis, congressional Democrats here in the States had been seeking greater environmental and labor protections in free trade agreements. That conversation, that movement, somewhat abated since then. But at the time, it was very concerning to trade partners of the United States. My question is, what do you feel is the best way to simultaneously ensure free trade without eroding labor and environmental protections?
Well, first, I think the first thing that we have to do is to do serious research and see whether freer trade has meant lower environmental or labor standards, either in NAFTA or in other cases. And it seems to me, with the review that I have made of the literature, that in no way that has happened. So I don't think that people that say that they don't like free trade agreements because they go against the interest of the workers of the developing countries or the environment of the developing countries are really telling the truth. I think they have another agenda. And basically what they want to do is to suppress competition. They don't say it like that because, well, you live here in a free society where the belief in economic freedom is very strong, so they will never say it like that. They will not admit it. But for me, it's obvious that that's the agenda, because now we have how many years of NAFTA? We have more than a decade, and I don't think anybody can show a single significant case, and actually we can show exactly the opposite, that NAFTA has been good for the environment, and NAFTA has been good for Mexican workers, and I sustain also good for U.S. workers. So I think it's not the Democratic Party. I think it's one sector of that party, which is unions, that have that agenda, and they don't want to be explicit, but it's essentially a protectionist agenda, and therefore, in my view, a regrettable agenda. Okay, let's move here. First row. Important people, first row. So they invite me here. Back again.
I was reflecting on your presidency before coming to your talk, and I didn't think the Mexican peso would again be under such trouble, but it seems that the strain is there again, and the government under Mr. Ortiz has to intervene. How much do you think government intervention by Banxico can stop the move against the peso?
Well, again, we are in this paradox in which the country where the big trouble started, because for too long the U.S. was borrowing too much money, having a huge current account deficit, and where these financial developments led to what we know now, and we are suffering now. Yet the currency that has strengthened is the dollar. So it's a bit of a paradox.
It is.
Not so much because the U.S. can print dollars. Treasury bills are denominated in dollars. So nobody expects the U.S. to default on the Treasury bills. So given the panic that there is in financial markets, everybody is running away from other currencies. And this is not only the Mexican peso, it's also true about the euro, also about the yen, even the Swiss franc. And they are going into dollars. And this is putting pressure on these currencies, including the Mexican peso. I think the central bank is preserving the integrity of the flexible exchange rate regime and is just trying to use what we have, which is a little bit of our significant reserves, to allow a more orderly adjustment in the market. I think that as long as they are measured in this intervention, is fine. But of course, I believe that the integrity of the flexibility of the market should be preserved, because that is going to be, has been, and it will continue to be one of our best defenses against the international financial instability. You.
Thank you very much for coming to talk to us tonight. I was curious about, you talked a little bit about the determinants of growth in Latin America earlier during your lecture, and I was wondering if you could talk a little bit about how these determinants of growth could potentially change in the face of the global economic recession. We saw that in the East Asian Miracle, the quality of human capital and educational improvements and skills upgrading was a major determinant in total factor productivity, and how that kind of drove growth in those countries, and how that model has been constantly looked favorably upon in Latin American countries. But then again, with the global recession happening, will there be a different prioritization of what these determinants are going to be? Would the focus be on the capital, on the human capital, and total factor productivity determinants, institutions, entrepreneurship? Do you think leaders will start to think differently about these determinants?
Well, that's a good question. And I think that's one of the big, has to do with one of the big risks at this moment in Latin America. We, Latin Americans, have taken every opportunity to run away from the right policies. And I am afraid that politically, given this crisis, which is a crisis of global capitalism, because something has failed, as cyclically has happened in history, for 3 centuries, history of capitalism, will be used to say in our countries, you see, market economy, openness is no good. Let's go back to our inward-looking approach to do things. I am afraid that there is going to be a strong political current that will go that way. And I know it because we have done it before. But I think we must resist that, because it will be a tragedy. A tragedy. If we go that way, well, this crisis will be worse for us, but not only that, I think we will be canceling growth opportunities in the future. And that's why what I am trying to suggest in my presentation is that number one, well, we must accept reality and try not to swim against the current, because otherwise we will be drowned as we were before. And we should adjust in an orderly fashion to the situation. the adverse situation. And number two, that during this moment of slowness in the economy, probably we should take the opportunity to renew the process of reform that would make us more competitive. And my idea is that a very strong point of agreement can be achieved in Latin America on the question of rule of law, which is a basic question of human rights, but it's also a basic question for improving the functioning of our economies. Instead of thinking about revisionist models, socialism in the 21st century or things like that, well, I think we should go back to basics and really think how to make our societies function better and in a more just way. And I think on this, all political parties, at least in Mexico, in Brazil, hopefully in other Latin American countries, can have an agreement. But the basic point is that if we use this crisis as an excuse to go back to our old ways, it's going to be tragic. And unfortunately, it will happen in a few countries in Latin America, and it's going to be very, very sad. Okay. Okay. You choose. Okay, go ahead.
I just wanted to get your opinion on how you think Hugo Chavez should be dealt with.
On what?
I wanted to get your opinion on how you feel Hugo Chavez should be dealt with.
Dealt by whom? No, I think one thing that we shouldn't do is try to deal with Mr. Chavez from outside. I think one of the things that have strengthened Mr. Chavez is the idea that foreigners can fix the situation in Venezuela. And in that report I was mentioning, in the report with Brookings, we said, no, the U.S. has to have a normal, respectful relationship with Venezuela. And if the Venezuelans keep electing Mr. Chavez, well, it's their problem. They will pay the consequences. But I don't think we should intervene from outside to do anything with Mr. Chavez. You have.
To go back to your analysis in the Latin American Commission on Drugs and Democracy, it seems like the trend is to try to engage America in acknowledging their part on the problem. President Calderon just mentioned, as you mentioned, that they shouldn't just try to contain it at the border, but should try to stop fueling it from this side of the border. But my question is, how do we engage the United States in participating in prevention rather than just containment? And also, how do you feel that a new approach to the drug war fits into the context of the problems with the Mexican economy?
Of the what?
Into the context of the Mexican economy in the future, in alleviating the conditions that the Mexican economy is in now.
Well, on the second part, I don't see much relationship. Even as big as the drug business is for the drug dealers or whatever, in terms of the size of the Mexican economy, is not significant. I mean, that's not really the issue. The issue is that it's a lot of money that fuels crime and violence. It's important in that respect. How to engage the American side? I think doing what we are doing here tonight, speaking about that topic, being open, being objective, looking for the evidence. One thing that we have said in the Brookings Commission, well, at least look at the experience of other countries, what they have done, and consider, approaches like minimum damage or reduce the damage, introduce or test new criteria, go for pilot tests, experiences with new approaches. So I think the dialogue, not only with politicians, but also among intellectuals and scholars, is very important. I think we have to make people, aware, the intellectuals, how bad this situation is, and that they should speak out and talk to the people and talk to the politicians, because right now the dialogue is non-existent. Okay, how are we doing with time, Professor Gallo? One more, okay? You, please.
Thank you. I have a question about Argentina. I just came back from there a few months ago, and when I was there, the people were all upset because the government had just, I believe, nationalized the pension fund in order to make its foreign exchange balance of trade payments to the United States. And I wondered, and they had just gotten through, 4 years after the devaluation of the peso. And what is your view on that kind of a move by the government to just take over the private pension fund in order to pay the United States what they owe us? It's probably more complicated than that, but I don't understand. Was that legal for them to do that?
Well, I don't know whether the Argentinian government told people that they were going to take the money for that purpose. That is not true. Oh. They are taking it. Well, they said that to protect it from the financial system. That was the formal reason. They said, "Oh, you see how money is being lost in the United States," which is true, by the way. My pension fund as professor is shrinking. The TIA CREF. I guess you guys are suffering the same, because it goes a bit with the stock market. So they said, "Oh, we need to protect the pension funds from these private financial people." That was the formal excuse. But the talk of the town is that they want to use that to finance the government deficit. That's the reason. And obviously this is not going to be good for the Argentinian economy.
Thank you.